London. September 21st, 1931. For a century, Britain has told the world that the pound is as good as gold. Then, in one day, Montague Norman's Bank of England stops making that promise. Not after a revolution, not after an invasion, after 4 months of banks, cables withdrawals, guarantees, and doubt moving across Europe faster than governments can answer. The chain begins in Vienna. May 11th, 1931. Creditanstalt, Austria's most important bank, admits a loss of roughly 140 million shillings. That number is almost the size of the bank's capital. A real bank starts to look fake. To the public, it is a disclosure. To foreign creditors, it is a warning. The balance sheet they trusted may have been fiction. Creditanstalt is not just a local bank. It is tied into Austrian industry. It is funded by money that can leave the country quickly, and the Austrian state cannot let it collapse like an ordinary firm. That is why one accounting line in Vienna can become a currency problem in London. Louis von Rothschild sits at the top of the board, but this is not a dynasty story. The danger is bigger than one family and colder than one scandal. Governments are trying to defend banks, defend currencies, and defend gold at the same time. By 1931, that promise is starting to fail. The explosion in May was built inside a rescue 2 years earlier. In 1927, 1 weak bank's problems were pushed into Boden Creditanstalt. In October 1929, Boden Creditanstalt problems were pushed into Creditanstalt. The crucial trick is not glamorous. Assets are not honestly marked down. The losses remain in the system, but they stop looking like losses in the present tense. Politics helps the concealment, but so does structure. Creditanstalt is tied to companies whose own values are falling, so what looks manageable in one season looks impossible in the next. By the time the 1930 annual report has to be finalized, the accounting runway is over. The bank has been surviving on delayed recognition. And once the weakness is public, the relevant audience is no longer Vienna alone. The first important reaction is not domestic outrage, it is foreign withdrawal. Short-term money in Hamburg, Zurich, and London does not wait for Austria to explain itself. The Austrian state answers quickly. On May 14th, it announces a rescue package, government money, central bank support, and Rothschild money together. That sounds decisive, but it creates a second problem immediately. At the Austrian National Bank, the rescue now has to do 2 jobs at once: keep the bank alive and keep the shilling believable. Under gold, a banking rescue is not just a banking rescue. The more Austria demonstrates willingness to support the bank, the more foreign creditors start asking what stands behind the currency promising to support the state. On June 27th, the contradiction becomes official. Austria guarantees 1.2 billion shillings of Creditanstalt liabilities, roughly 2/3 of the entire federal budget. The bank is no longer merely a bank problem, it has become the state. That contradiction is the real villain of the episode. A national rescue can be rational inside Austria and still destabilizing from the perspective of everyone lending to Austria from outside. So Basel enters the frame. The Bank for International Settlements extends credit, and the new international institution is immediately forced into improvisation. That is the system's lesson. The rescue is real, the withdrawals are also real. The two lines do not cancel each other out. Once you see the geography, the next step becomes obvious. Austria now needs outside confidence, not just domestic resolve. And in Europe in 1931, confidence has a geography. France is sitting on the strongest gold position in Europe. Austria is not negotiating from strength. That matters because Paris can help make a rescue credible, and Paris can also decide what price it wants in return. In March, Austria and Germany had proposed a customs union. In June, that political project gets dragged into the banking rescue. This is not a cartoon of French sabotage. It is a simpler and more dangerous thing. A rescue starts moving at diplomatic speed while the markets keep moving at market speed. London is less comfortable. Montague Norman wants the fire contained, but London does not have France's reserve cushion. That is the pattern of the whole crisis. Every intervention is just large enough to delay the next decision. And because every stage takes time, the crisis gains room to jump from Austria into Germany. Then Washington tries to slow the entire machine. On June 20th, Herbert Hoover proposes a 1-year suspension of intergovernmental debts and reparations. The idea is elegant. Stop sovereign pressure long enough to steady the banking system. But notice the limit. This can pause state-to-state obligations. It cannot make private creditors patient, and it cannot repair bank balance sheets already under suspicion. A proposal is not a pause. France does not accept immediately, and the 2 weeks between June 20th and July 6th turn out to matter. By then, the pressure has shifted to Germany, where the next weak institution is even harder to isolate. On July 13th, Danette Bank cannot pay. Germany declares a bank holiday. The important point is not that Vienna mechanically caused Berlin. It is that the same cross-border funding structure is now under suspicion everywhere, and Germany is the next place where that suspicion becomes impossible to hide. By mid-July, Europe no longer has just a banking problem. It has a banking crisis and a currency crisis at the same time. And that question has a London answer, because the interwar system is not held together by Austria or Germany. It is held together by sterling. Germany responds with closures, restrictions, and then exchange controls. By early August, the mark is effectively no longer operating as a freely redeemable gold standard currency. That is the hidden geometry. London sits in the middle. If sterling looks weak, central banks and investors do not have to wait for Britain to fail. They can ask for gold first. This is why 1931 feels different from a simple national bank run. Countries are holding one another's currencies as reserves. The system is efficient in calm weather and fragile in a storm. When confidence moves from Germany to sterling, the Bank of England starts losing the one thing the legal system still says sterling is supposed to represent. You do not need every accounting detail. You only need the direction of the line, down. Then comes Invergordon on September 15th, when Royal Navy ratings refuse exercises over proposed pay cuts. To foreign holders of sterling, it reads as one more sign that Britain is trying to defend gold with a political system already under strain. At this point, the decision is no longer theoretical. Britain can keep promising gold, or it can keep enough room to govern. It chooses government over metal. On September 21, 1931, Britain passes the Gold Standard Amendment Act. The legal promise to sell gold bullion on demand is suspended. Sterling drops sharply from its gold parity against the dollar. One of the central prices of the world is now moving again. Within weeks, over 20 countries follow Britain off gold. The old monetary architecture is no longer a rule. It is a memory. That is the mechanism. A hidden merger becomes a public disclosure. The disclosure forces a rescue. The rescue stresses the gold peg. The stress spreads into Germany, then sterling, then the world. Creditanstalt did not single-handedly invent the catastrophe of 1931. It did something more historically important. It showed in one morning that the interwar gold standard could survive confidence only while confidence stayed hypothetical. The Vienna Bank did not break the world by itself. It revealed that the world it was living inside had already become breakable.